If you are an investor in Singapore Airlines, you probably saw the headline and felt that pit in your stomach. A stunning 67.8% plunge in net profit. If you hold UOB, it looked even worse on paper, with a massive 72% drop in year-on-year net profit. These are the kinds of numbers that make retail investors panic sell. Headlines like these scream, "Get out now." If you just glanced at your brokerage app this week, it looks like the Singapore market is falling apart while the rest of the world is moving on. But if you strip away the one-offs, the real decline for the banks is nowhere near that disaster scenario. If you look past the terrifying headline number for UOB, you realize that they didn't lose that money from operations. They chose to hide it away for a rainy day. The headlines are telling you that the Singapore trade is dead. But the real data is telling us that the smart money is actually rotating, not exiting. This is a much more complex story than a simple earnings miss. It's about strategic kitchen sinking, the difference between pricing power and price wars, and a massive opportunity in the bond market that almost nobody is talking about. I am Iggy, your Singapore-based market analyst, and my job is to cut through the noise, ignore the sensationalist headlines, and show you what really matters for your CPF, SRS, and SGX portfolios. And we have been putting in the work to earn that trust. Since October 2025, this channel has produced over 200 videos with more than 600,000 watch hours dedicated to analyzing this market. We were honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers list. My focus is always on regional and global trends to give you broader context so you can uncover hidden gems and potential pitfalls that the mainstream news misses. Today, we are going to do exactly that with a deep dive, slide-by-slide analysis through the November earnings shockwave. First, we have to address the elephant in the room, which is the banking sector divergence. Specifically, why net profit is currently a lie. The headline news was terrifying. UOB reported a Q3 net profit of just 43 million Singapore dollars, roughly a 72% drop year on year. If you only read the headlines or if you just saw a red arrow on a notification, you would have panic sold. But we need to look closer. The disaster was actually a strategic masterstroke. UOB is not losing money because borrowers are defaulting today. They are stockpiling cash because they think borrowers might default tomorrow. They took a massive $1.36 billion allowance for credit losses. In the industry, we call this kitchen sinking. Imagine cleaning your house and throwing every single piece of trash out at once. That is what UOB did. They took all the potential bad news, all the possible future losses, and recognized them right now to clear the decks for 2026. This means future earnings will look artificially cleaner and stronger because they have already taken the hit. However, while DBS and OCBC remain steady ships, the real story across all three banks is the end of the easy money era. We are seeing net interest margin, or NIM, compression across the board. Net interest margin is the difference between what the bank earns on loans and what it pays out on deposits. When interest rates were skyrocketing, this margin was huge. Now it is shrinking. We saw DBS dropping to 1.96% and UOB dropping to 1.82%. The free cash flow party driven by high interest rates is officially over. So what is Iggy's perspective on this? For us as Singapore investors, this is exactly what you want to see if you're a long-term holder. Do not fear the drop, follow the pivot. The banks are aggressively shifting from lending money, which is cyclical and risky, to managing money, which is sticky and fee-based. The real signal isn't the profit drop, it's DBS hitting a record $796 million in wealth management fees. That is the future. If you hold banks in your SRS account, ignore the headline profit drop and check the CET1 ratios. All of them are above 15%. That means the dividends are safe. UOB is now a contrarian value buy for long-term holders who understand that the loss was an accounting cushion, not a cash burn. Now, moving to the second major theme of the month, the reopening trap, which involves Singapore Airlines and Genting Singapore. This month offered the most critical lesson of the year on pricing power. Both SIA and Genting rely on tourism. They are plays on people traveling and spending money. Yet one crashed while the other soared. Why? The difference is in who controls the price. SIA is suffering from yield decay. Despite revenue hitting a record high, first half net profit collapsed to $239 million. The culprit isn't demand. Planes are fuller than ever. The culprit is competition. There are aggressive capacity increases from Chinese and Middle Eastern carriers, flooding the market with flights and forcing ticket prices down by 2.9%. At the same time, costs for fuel and staff have risen. SIA is running harder just to stay in the same place. They do not have pricing power because the consumer can choose a cheaper airline. Now look at Genting Singapore. They are enjoying monopoly power, 19% profit. Jump to $94.6 million wasn't an accident. Resorts World Sentosa operates in a walled garden. Unlike economy passengers who price shop flights, VIP gamblers don't price shop casinos in the same way. Genting raised its win rate and gaming revenue by 22% because they cater to a captive luxury audience. Looking ahead to 2026, you must avoid businesses fighting price wars. SIA is locked in a brutal dogfight for every passenger, while Genting owns the arena. The broad reopening trade is dead. The luxury pricing trade is the only one left alive. While the market obsessed over volatility in banks and airlines, one company quietly delivered the kind of boring, robust news that defensive investors dream of. ST Engineering reporting a record order book standing at $32.6 billion. An order book represents future revenue that is contractually locked in, the ultimate sleep well stock. Unlike banks tied to interest rates or airlines tied to volatile oil prices, ST Engineering is anchored by long-term government and commercial contracts. Their commercial aerospace division is soaring as airlines spend heavily on maintenance to keep older planes flying. Their defense arm is benefiting from rising geopolitical tensions globally. When the market is volatile, you want visibility, and a $32 billion backlog gives you revenue visibility for years. This is the third leg of a defensive portfolio, balancing financial and tourism risks with pure, boring industrial stability. Now, the biggest opportunity I see right now is the fat pitch, the relationship between REITs and the 10-year Singapore government bond. For the last 2 years, REITs were dead money. It made no sense to take the risk of owning a mall when you could get a risk-free 4% yield from a 6-month T-bill. But in the last few weeks, that math flipped violently. As of mid-November 2025, the 10-year Singapore government bond yield has crashed to approximately 1.95%. This has created a massive opportunity. High-quality REITs are still yielding between 5.5% and 6.0%, meaning the yield spread, extra cash you get for taking on risk, is now around 355 basis points. Historically, whenever the spread widens past 300 basis points, REITs tend to significantly outperform over the next year. Anchor for this strategy is Fraser Centrepoint Trust, or FCT, which recently posted a retail committed occupancy of 98.1%. But that number includes the exit of Cathay Cineplexes. Without that, their occupancy is 99.9%. With rental reversions at plus 7.8%, this is a necessity bucket play. People in Yishun and Tampines don't stop shopping because of a recession. With the 10-year yield below 2%, FCT acts as a bond proxy paying nearly triple the government rate. Then there's the growth engine, CapitaLand Ascendas REIT, or KLAR. Occupancy dipped slightly to 91.3%, but this is strategic softness as they rejuvenate older assets. You aren't buying KLAR for today's rent, you're buying it for their pivot to the digital economy. As they recycle capital from old warehouses into data centers and logistics hubs, they are future-proofing the portfolio. So, how do we bring this all together? What is the investing Iguana playbook for the 2026 horizon? We are moving from a growth cycle to a quality cycle. Here's what is working. Local banks' balance sheets are a fortress, Genting's monopoly power is resilient, and the bond market crash has made REIT yields incredibly attractive again. These are the green flags. Here is what is not working. Yield decay in airlines is real and structural. North American occupancy for global REITs is still a problem, though our local focus shields us a bit. And the easy money from interest rates for banks is gone. What is the valuation verdict? For current bank unit holders, especially UOB, the yield is decent, dividends are safe, and the bad news is priced in. For new buyers, I am in the aggressive accumulate camp. I am buying the dip on UOB because the market punished them for being prudent. The kitchen sinking created value entry. For REITs, I am aggressively loading up on high-quality names like FCT and CLAR when the risk-free rate collapses to 1.95%. A 5.5% dividend yield becomes the most valuable asset in the market. This is the fat pitch. For ST Engineering, this is my recession shield. I am adding to this position for stability. SIA, I give a warning. I love flying SIA, but I won't buy the stock. The 67.8% profit drop is structural, not temporary. Until yields stabilize and oil prices reset, it's a watch, not a buy. The risk reward isn't there now. If you found this valuable and want to keep up with rapid market shifts, consider becoming a free or paid subscriber to our Substack newsletter. You will be in good company. The Investing Iguana has hit over 1.3 million reads with 65,000 likes across our platforms. And we're welcoming our growing community of 30 plus YouTube premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Thanks for watching, and I'll see you in the next analysis.